All right. So I guess my presentation is not going to be as exciting as the previous one. Let's see, who do we have in the audience? How many entrepreneurs are in the audience? Okay. How many investors? No investors. All right, good, because presentation is actually for the investors. So that's going to work out well. So my name is Igor Taber. I'm investment director at Intel Capital, responsible for all of our investments in Russia and CIS countries. So it's kind of a general topic, but really what we wanted to do is we've been investing here. Do I have the? How do I change the? Okay. So what I really wanted to do is we've been, I'll say a couple words about Intel Capital just so you understand who we are. So we are a global venture capital organization that's part of Intel. We are present in something like 25 countries. We've done investments in probably more than 50 countries. So we have a fairly global perspective about investing and various ecosystems, startup ecosystems, etc. So what I really wanted to do today, and what I tried to do, is we've been investing in this region meaning Central Eastern Europe, Russia, etc., for a while. Our first investment in Eastern Europe was in 1999. Our first investment in Russia CIS was in 2002, and we've done a very large number of investments, more than 28 investments in all of Eastern Europe, 13 of them in Russia, etc. So we've done quite a few investments, and some of them have worked out very well, like Yandex. Some of them have not worked out so well. But what I really wanted to do is to share some lessons that we learned over the last 10 years of investing here, and why we're interested in the region, what works, what doesn't work. So given that I thought the audience was going to be more investor-oriented, I think I targeted the presentation towards that, but I'll try to hopefully adapt it a little bit and talk about it more from the entrepreneur or startup perspective. So first off, investors are very simple people, and really, this is a very standard 2x2, the way lots of investors think about investing, right? And so, if you look at this 2x2, there is wrong investments and there are right investments, right? There are wrong companies to invest in and there's right companies to invest in. And of course, nobody wants to be in the wrong column. Everybody wants to be in the right column. That's pretty obvious. And then there is, segments, companies, opportunities that everybody knows are great. It's what's called consensus. And so everybody wants to be right about the investments they do. But if you invest in the things that everybody thinks are right, everybody wants to invest in it. Everybody thinks it's great. Everybody thinks, social networks are good. And so you're going to invest where everybody wants to invest. You may win. You may generate good returns. But your returns are probably not going to be as good because everybody else is investing in the same space. Valuations are high, etc. So from an investor perspective, where you really want to be in this quadrant. You want to be right, but you want to be right about things where not everybody agrees are right. Right? So some people think it's good, some people think it's bad, and you pick it, you make a bet, and you end up being right. That's where real good returns coming from. And so from my perspective, Central Eastern Europe is like that, right? There is no consensus from global venture capital communities that you should invest in this region. Some funds do invest, some funds do not invest. But that's really the opportunity, and why we invest is because we believe it's the right place to invest. And that's really what will drive the returns. So that's where I think the Eastern Europe is in this bottom right quadrant. So when you invest, either when you invest from an investor perspective or you looking to attract investment from an entrepreneur perspective, in my opinion, there are really only 6 things that matter. And I'll talk a little more about them. Only 5 things that matter, and the last is just being local or going global. It's just my personal opinion as to when the company should go local, go global or stay local. So from an investor perspective, probably the most important thing if you're an investor is to have a deal flow, is to have lots of potential startups that you can invest in. And that's really how one investor differentiates itself from the other investor. When you're a startup, people will ask you, what's your competitive advantage? And you're going to describe your product. You're going to describe, you have great product. That's why you're better. You have different go-to-market strategy, et cetera, and that's your differentiation. Investors also need to differentiate from each other. And really, number one result of that differentiation is the quality of the deal flow and quality of the companies that you're seeing. The reason, there are very successful venture capital funds in US is because the ones that are successful tend to see the best deals. And then the deals they don't invest in, the next tier of investors get to invest in the ones that the best investors have passed on, and those are probably not as good of a companies. And that's kind of a self-fulfilling thing. And so when you look for deals in this part of the world, I kind of divide them into two areas. There are a few companies that everybody knows about. Everybody, press writes about them. They probably have a very outspoken founders who are all over social networks. Everybody knows about the company. All the investors know. All the entrepreneurs know, etc. Usually, those companies that have very high valuations from an investor perspective, and it's also becomes more difficult to differentiate kind of where's the hype and where's the reality. And I'm sure you all have examples of companies that seem to be very well known. Everybody knows about them, but they're actually not as good. And usually, those companies are able to attract a lot of capital, which again makes its companies expensive from an investor perspective. But what happens in this part of the world, there are many companies that no one knows about. Usually they are, bootstrapped. They have not attracted much of external capital. They're very profitable from almost day one. And they're probably managed by the original founder or founders. Usually there are a couple things about those companies. First of all, they've proven that they can build the business without any help. And that's usually very important, and that shows the quality about the company, etc. On the weak side is they're usually, a lot of those founders are hard to communicate with. They have very different expectations of what the venture capital is, why do you need it, because they did not need it before, they just built the company themselves. And another thing from an investor perspective in such companies is it's hard to find a way to effectively manage those companies from an investor and board perspective, is because those companies are now big. You may be able to invest, but you only will be able to buy a small part of that company, and hence the founder continues to own majority of the company and continues to control the company. And that may be good from a resort perspective, but from an investor perspective, it makes it more difficult to help the company and influence the company, and that's the minus. But whatever you do, and that's again most message for venture capitalists is, if you want to have a quality deal flow, you have to be present locally in the market. You cannot do it out of London. You cannot do it out of Silicon Valley. You have to be a local. And we've been a local here for 10 years, and I think we have fairly good deal flow, and I think that's as a result of that. Probably more important point is cash, cold, hard cash. At the end, how fast you can grow depends on how much cash you have, right? And what's the typical mistake that a lot of founders make is they optimize, they're very dilution sensitive as they should be, and they optimize how much money they raise to minimize their dilution by a couple percentage points. But what happens, and that's kind of maybe somewhat unique to this part of the world, the follow-on financing and follow-on cash is much harder to get. For example, in the last quarter, in the second quarter of this year, there was only 8 growth expansion deals done in Russia and Ukraine. Growth expansion deals, for those of you who don't know, that's follow-on, it's second, third, fourth round of investments, which helps the company scale. But there was only 8 of those, right? That's not many. And so my advice to entrepreneurs would be, if you're able to raise more cash early, it may mean a little bit more dilution, but it will give you a longer runway, and you will be less dependent on being able to attract more capital later to grow the company. Another thing that happens when there's not enough cash, that leads to a lot of unnatural behavior by everybody involved. So the entrepreneurs start optimizing themselves for extending cash runway, which impacts the growth. Investors are running scared, etc. So bottom line is, you want to make sure you have cash. And so if you're able to fundraise, I would always advise to raise more versus raising less. There's some other opinions about this. Some people would disagree, but that's kind of our personal opinion. I'll skip this because this is again more for investors. It's advice for the investors versus the entrepreneurs, and given that there is no investors here, that's not all that relevant. Investors always talk about value add and how the investors bring value to the companies, etc. And I think I would say a couple of things. I think it's important for any investors to know when to lean in and when to lean back. The investors, by definition, I call them output judgers, right? They actually don't know what's going on in the company. They're not there with you every day. They don't sit in your office. They don't really know. All they know is what you tell them and what they hear from other sources and other, market signals, etc. And so all they can do is judge output. When things work out great, they're not going to bother you. They're going to lean back. They're going to say, hey, this guy or this lady is doing a great job. I don't really need to be involved. They're doing great. So they'll lean back. But when things don't go as well, you're going to start seeing reaction, right? They want to know, why are things not going so well? Why are you not executing on the business plan that you've shown me? Why are you not signing up that customer? And so they'll lean in and they'll start asking questions, and they'll be a lot more intense in terms of them trying to understand what they want. So from the investor perspective, it's important to kind of lean back when things are going great, but also know when to lean in to help the company. And I think that's an important skill in terms of investors to know how to manage the company. But probably the most important value that investors can give is introductions. At the end, presumably the investors have a lot more network than, let's say, the first-time entrepreneurs, and they have to be able to bring that network, those relationships to their company. We at Intel do that all the time. We have lots of programs where we introduce our portfolio companies to Intel customers. So Intel has a very big sales force of about 2,000 people selling Intel products. And so we try to leverage all those relationships with major companies around the world and help our portfolio companies to be introduced to them. And we do that quite effectively at fairly large scale. Another thing that investor brings is exits. So at the end, companies get sold, entrepreneurs get rich, but in this part of the world, the exit opportunities are quite limited, at least for now. There's not that many M&As going on. Google buys, 20 companies a quarter in US. How many companies does Yandex buy in this part of the world, right? So exits are still far few in between. I think this will change, this will improve, but that's the reality today. And so you really want to be number one player in the segment that you're in, because usually the number one player will get a lot of premium and will get a lot of interest from an acquirer. But because there's so few acquirers, number two guy will have much more difficult time being sold or generating interest. But at the end, selling companies is just like selling tomatoes. Excuse me. Selling companies is just like selling tomatoes. What do I mean? So when you buy tomatoes, you can't actually get on the inside of the tomato, right? All you know is the guy who sells tomatoes, and he sells good tomatoes, but you can't really get on the inside of them. So when you buy tomatoes, you try to go to the guy who you know. Same thing when companies get bought, the acquirer can't really get on the inside of the company. Yeah, they will do due diligence, they will research it, etc. But truth is, they don't really know. And there's only so much work they can do to really understand the company from inside out. And so what they like to do, they like to buy it from people they know. For example, if you're a well-known venture capital fund and you sell the company to Google, that's not the only company you're going to sell to Google. You're going to sell 20 more companies, in the next 10 years. So you really want to make sure that you maintain good relationship. And if Google know you sell them, crappy companies, they probably won't buy the company from you again. And so for venture capital, it's very important to maintain that reputation with potential acquirers, and acquirers know that. And so they like to buy from people they know, because they know they have this ongoing relationship. And so from an entrepreneur perspective, that's probably number one value, or significant value you get from an investor, is by having investors that acquirers know, because that will be easier to sell the company, it will generate premium for the company, etc. So just like selling tomatoes. Really this slide is about, what's better, to have the founder as a CEO of your company or to have a kind of an external CEO to run the company. Again, different funds have different opinions. Our opinion is that there's nothing better than the founder continuing to manage the company. In fact, all the companies that have been successful for us have always been founder managed. And that's probably lots of reasons. And every time you needed to replace a founder with the, let's say, what's called a professional CEO, that usually doesn't work out. Especially in this part of the world, because there's actually not that many professional CEOs, right? There's not that much management talent yet. And so when we invest, we wanna assume, and one of the things we wanna try to make sure is that the founder or the founders can continue to run this company at least for the next 3, 5, 7, 10 years, whatever it takes. It's not easy to replace founders. It's very disruptive for the company. It's very disruptive emotionally for the founders. And it usually means bad things are going to happen to the company. So I would not advise to try to replace the founders many times. And bottom line, from an investor perspective, if I don't think that the founders or the current management team can run this company for the next 3 years, I probably wouldn't invest. I would not assume that I'm going to be able to easily change the management team because it's not easy to do. But of course, if you need to make tough decisions, you have to make them, and you have to make them quickly. So I think only the last slide I'm going to say, which is, I know, very relevant for this audience, is there's lots of questions. Should I build a global company or should I focus on the local market? What should I do? A lot of people say you should go global right away. My opinion is you should only even consider going beyond your local market is in kind of 3 situations. If you're building an enterprise-oriented company where your customers are enterprise, you're likely to have to go global from day one, mostly because those markets are very small in this part of the world. But however, if you're in the consumer market where consumers are your customers, I wouldn't even think about it until you reach $50 million in revenue in the local market. Because the Russian-speaking consumer market are very large. In Russia, there are now multi-billion-dollar companies have been created in the internet space. Just focus on Russia. Yandex reached $12 billion in market cap without worrying much about beyond Russia. Mail.ru reached whatever they are, 6, 7 billion, Kiwi, etc. All those companies are multi-billion-dollar companies, and they didn't need to do much outside of Russia or Russian-speaking countries. And so my advice is, if you're in the consumer space, just focus on your local markets, at least until you become a very sizable company, and then you may think about how do you expand further. But also, when you think about going to US or other places, I would consider a few things. If you're going to go to US, you have to hire the team in US. Sometimes it's a sales team, sometimes it's a management team. But in our experience, it's not an easy thing to do. They're very different cultures. If you hire a professional American CEO or VP of sales, there has to be a very strong, almost perfect cultural fit. Because you have a lot of things going against you, right? It's very hard to run the company on 2 continents. Even if you like the same culture, speak the same language, everything, right? It's just hard. Most startups, I sit in the same office. Most startups in Silicon Valley, I sit in the same office. They don't even have offices. They sit in open space because the communication is very important. So when you start having, one office in US, another engineering office in Ukraine or Russia, you're already making it more difficult by just having time difference, language differences, etc. And if you add to that a potential cultural misfit, different ways of doing business, different expectations, that becomes almost unsolvable problem. So the first piece I would advise, if you're going to hire somebody in US, really, really spend a lot of time with them before you hire them, and make sure that they're comfortable. There's just a culture, there's just chemistry between a local team and the, let's say, US team. But probably what's better is if at least some of the founders, probably non-technical founder, is also able and willing to move to the market where they think their customers are. Again, nothing better than founders run the process than non-founders. And so I would recommend that. And probably the most important consideration when you're considering going global is you really have to make sure that the solution or the product that you're offering is very, very clearly disruptive. I mean, those markets are so much more competitive. And so you really want to make sure that the solution you have is that much. It cannot be a little bit better than other solutions in the market. It has to be 10x better. Right? If there's incumbent players in the space and you want to disrupt them, you cannot do it by being just a little bit better. You have to do it by being 10x better and just completely changing the games. And that's really the test that you have to convince yourself that you're able to pass. But if you don't have those things, my advice would be to focus. The only advantage you have as a startup is by having that focus. The only advantage you have as a small company versus a big company is by being able to very narrowly focus and execute fast. And things like global expansions inevitably will make it hard to focus. So unless you can able to show that you can do all those things, I would recommend stay focused for time being on the local market and be successful in your market. So that's it.